Good afternoon, everyone. I am CA Megha Saxena, Secretary to Auditing and Assurance Standards Board. On behalf of the board, I welcome all the participants to this webinar, Decoding SA 210, that is agreeing the terms of engagement. SA 210 plays a pivotal role in setting the foundation for the effective audit by clearly laying down the responsibility of both the auditor as well as the client. So today with us, we have our very renowned speaker, CA Ganeshan sir. So he's also a board member. So I will briefly tell you about his profile. Dr. Ganeshan began his journey as a chartered accountant in 1988 and has since built a remarkable career working with both the Indian and the multinational clients across sectors. He has served the leadership role in the prestigious firm like Lovelock and Lewis as PwC Network Firm and BSR and Company LLP, and currently leads as the managing partner to RKCG and Associates LLP. CA Ganesan also serves as an independent director and audit committee chair in reputed companies including Karur Vyasya Bank and Belstar Microfinance, and also served as an independent director and Railtel Corporation of India. We are very thankful to you, sir, for accepting our proposal and addressing the participants and sharing your valuable experience with them. I would request CA Ganesan sir to please take over. Thank you.
Thank you, Megha, for this opportunity of meeting all my fellow colleagues through this webinar. And one of the important topics which always, if it is not properly applied, lands the auditor into trouble is the terms of engagement if not confirmed with the client on a proper basis. So since we know that standard SA 210 and every auditor is actually trying to get the engagement letter in every case and keep it on file, what we thought is maybe a brief on SA 210, and then we will move on to the practical issues, common pitfalls, case studies, and what should be the best way in which auditors can actually ensure the compliance with the SA 210. Maybe I can use the word the SA 210 is the foundation of the entire audit work which the auditor is going to do for his client. So on that basis is what we are planning to do the entire activity. You can raise your questions by putting it in Q&A box or maybe in the chat box, which I will try to take it up at appropriate time and then answer those questions. To start with, we know that there are various activities a chartered accountant undertakes on behalf of the client. Maybe it is relating to audit and review services, or maybe any other related services. For example, if we are talking about an audit, it may be a statutory audit, or maybe a specific audit we might have done, or it may be a limited review where the auditor does not give a very high level of assurance. Maybe only a moderate assurance he is providing. Sometimes the client specifically wants you to do certain procedures and to report on the actual findings based on the work performed by the auditor. We call it as an agreed upon procedure. And in certain circumstances, the client actually wants the financial statement to be prepared by the auditor using some information which has been provided by the client, and not as a certification on the audit or the financial statement. It is only making it into a readable or presentable format. So we call it as a compilation of work. The question is, when we do an audit or limited review or agreed upon procedure or compilation of work, whether the letter of engagement is required only for an audit or it is for other cases as well. I must make it very clear, even though SA 210 says agreeing the terms of audit engagements, in all these cases also, the letter of engagement is critical so that the responsibility of the auditor, the responsibility of the management, the expected deliverables, etc., can be very clearly communicated to avoid a future miscommunication or misunderstanding between the auditor and the client. So in every framework, I believe that the letter of audit engagement is to be there. This particular SA 210 has been revised in 2000 in accordance with the ISA 210. So accordingly, if we comply with the SA 210, it is also equal compliance with ISA 210. This SA 210 is applicable only for audit of financial statements, and to that extent, the other services which I have listed out may not be specifically covered in the application guidance of this particular standard. But still, my suggestion is you can draw a parallel on this and agree the terms of other engagements also with a client, because how you have to agree upon this is there in every particular standards on auditing when we are doing a limited review or agreed upon procedure or compilation of work. The focus is basically agreeing the terms relating to the audit engagement. That means what is our role and what is the management role and what is the expectations of the client and what is the responsibility auditor has with respect to regulators or legal framework, etc., are very clearly spelled out in the terms of audit engagement. So accordingly, it will ensure a mutual understanding between the auditor and the management, how the audit will be performed, how the audit will be delivered, and what are all the other matters the auditor wishes to consider during the course of his audit engagement. So that's the reason why we believe that the SA 210 has certain specific objectives to follow. For example, if the letter of engagement has been entered into between the auditor and the management, it is assumed that various preconditions relating to an audit is actually in existence. When you ask what are all the preconditions for an audit, I can say that whether the audit, actually I have a slide to look at the preconditions. Anyway, what is the financial reporting framework under which the audit will be considered? That is also a part of a precondition which is being agreed. So it is presumed that the moment you enter into a letter of engagement with the client, the preconditions of the audit has been already checked and they are in existence. And this letter of engagement wanted to confirm the auditor's responsibility and of course management responsibility as well. But at the same time, the objective of SA 210 in having a letter of engagement is to mainly to ensure clarity of the scope of audit, and in case if there is that particular engagement will have, and in that particular scenario, what the stakeholders or the users of the financial statement can expect. Okay. So basically, it wanted to avoid misunderstanding between the auditor and the management and also between the stakeholders. The expectation is all these letter of engagement should be in writing. Sometimes oral discussion will be taking place in between the auditor and the client, but legally it is not binding. And accordingly, SA 210 expects that it should be in writing. That is very important. So the way in which we talk about the requirement of SA 210, I use the word the foundation of an audit engagement. So it sets the entire rules, terms, conditions, including the deliverables, etc. And accordingly, it is a foundation of an audit before an audit is actually being started. So this SA 210, whether it's optional or mandatory, when you ask, without a letter of engagement, you are not expected to commence any audit assignment. Because the majority of the observations by the regulators, even in peer review, is non-existence of letter of engagements. So in other words, A letter of engagement is mandatory, and accordingly, SA 210 is also mandatory for the accounting period beginning April 1, 2010. You may ask the question whether before that there is no requirement for a letter of engagement. It was there. Only thing is, 2010 it was revised, and accordingly, SA 210 revised is the reason why we are talking about this particular standard is effective from that particular period. The key to success of SA 210, we believe that how the auditor's letter of engagement manages the entire expectation and reduces a possible gap in the expectations. In other words, explicit pronouncement of the terms and conditions based on which the audit has been agreed upon is expected to be present in a letter of engagement in a very clear terms, right? So we said that there should be preconditions for an audit, otherwise SA 210 will not happen. And I also talked about the one of the example of precondition is acceptable financial reporting framework. The issue here is, in majority of the circumstances, if the auditor has not clearly spelled out what is the financial reporting framework under which the audit is going to be conducted, then the ultimate deliverable may not meet the requirement. For example, if the financial reporting framework, which is supposed to be followed, is Indian Accounting Standard or Ind AS, and the financial reporting framework followed by an entity is just AS, then it is the auditor's report should be in accordance with the applicable financial reporting framework, that is Ind AS, whereas the financial statement has been prepared under a different financial framework. I take two live examples which I come across in this particular scenario. There was one disciplinary proceeding which has been initiated, and I think that NAFRA also has reported this in one particular scenario in an audit quality report, AQR report, where the auditor's report has mentioned that the financial statements are in conformity with the Indian Accounting Standard notified under Section 133 of the Companies Act. Whereas in the basis for preparation of financial statement, it was mentioned that the financial statement has been prepared in accordance with the accounting standard prescribed under Rule 7 of the Companies Audit and Auditors Rules, Companies Accounting Standard Rules 2014. Even though the entire audit, the presentation, disclosure, everything was in accordance with Schedule 3 and Division 2, where the financial reporting format has been used, the entire disclosures as per Ind AS has been given, and based on which the auditor has also made the comment that it is in accordance with the applicable Indian Accounting Standard issued under Section 133 of the Companies Act. The regulator has observed that financial statement according to Indian accounting standards requires a explicit and complete compliance with the Indian accounting standard, without which it will not be considered as a financial statement prepared under Ind AS. It is there in Ind AS 1, where there is an explicit and unreserved compliance with Indian accounting standards has to be disclosed as part of the financial statement. Whereas the financial statement disclosed that it is prepared in accordance with the accounting standard notified under Rule 7 of the Companies Accounting Standard Rules 2006 at that point in time, right? The problem here is the regulator has observed the auditor has verified a financial statement under Ind AS, whereas it was prepared only as per AS, where the financial statement has not followed the applicable financial reporting framework. The auditor does not have a basis for issuing his audit opinion. The regulator has observed that. So, having the financial reporting framework and accepting what is the acceptable financial reporting framework should be very clearly spelled out in a letter of engagement. So, that is a preconditions for commencing an audit. Okay. Otherwise, it leads to litigations and other aspects of the scenario. I've also seen another case where the company is supposed to prepare and present the financial statement as per Indian accounting standard because its net worth was crossed 250 crores in one of the financial years. So the next year they are supposed to follow Indian accounting standard and present the entire financial statement in accordance with Ind AS. But there are some limitations which that particular entity was having, which was PSU at that point in time. So that PSU could not able to prepare the financial statement. It continued to prepare the financial statement as per accounting standard and ready to take a disclaimer of opinion or adverse opinion from the auditors saying that they could not comment on the applicable financial reporting framework because it was not prepared under the required reporting framework. So in that case, when the auditor knows it very well that the entity is not going to prepare as per Indian accounting standards, but later on coming to the conclusion that it will be an adverse opinion because it doesn't give a true and fair view, because all the account balances will have pervasive adjustments or material and pervasive adjustments required. Major disclosures required will be omitted. So, accordance with SA 705, it requires an adverse opinion, right? So, not considering the acceptable financial reporting framework will be an issue that impacts the precondition for an audit. So we have to be a little careful on this particular aspect. Even the slightest error. In that case, if I'm not wrong, in the first case, what has happened was that is the first year of adoption of Indian accounting standard. The notes on accounts has been simply copied, pasted from the previous year on basis of preparation of presentation of financial statements. Unfortunately, nobody has noted that which resulted in a big issue. The second is the management should accept for certain matters with respect to their responsibilities. As you know that auditor is only going to do an audit of a financial statement prepared and presented by the management. And accordingly, the management has to clearly spell out that they are responsible for preparing and presenting the financial statement in accordance with the applicable financial reporting framework. It is not only that, the management also agrees to ensure that the internal established and maintained throughout the audit period, because that is also very important for us to design our audit procedures and also to decide on what is the possibility of risk associated with that audit. And the third and foremost importance is management should agree to give complete access to the records, complete access to the various staffs relevant for the purposes of the audit. If the records and documents are not allowed to be accessed by the auditor cannot obtain sufficient appropriate audit evidence, and accordingly, he could not form a basis for his opinion. And accordingly, this access, unrestricted access to records and staff. Interestingly, what SA 210 says is that if there are no preconditions, or maybe if the preconditions are not met, it is assumed that no audit is possible. And accordingly, the letter of engagement should always start with checking whether the preconditions of an audit is existing or not existing. Then only the letter of engagement or agreeing the terms of engagement comes into the picture. The auditor's responsibility should be clearly spelled out in the letter of engagement. You know pretty well, even after we have spelled out our responsibilities, many times the client thinks that the auditor has more responsibility, but he has not performed his duties properly. Even if the client believes that we have completed our responsibility properly, the regulators always believes that the auditor's responsibilities are not being properly carried out or it is not being met properly. So accordingly, the letter of engagement should have proper disclosure or proper statement on what is the auditor's responsibility with respect to the audit engagement. So naturally, the auditor will say, since the management is supposed to prepare and present the financial statement, auditors are not going to prepare and present the financial statement. Auditor is actually going to express an opinion on the financial statement based on his audit. Okay. That opinion on the financial statement, as we have seen, that on the overall financial statement, whether the financial statements uh, does not contain any material misstatement, either due to fraud or error, is the objective or the of the opinion which the auditor is expected to give in respect of a financial statement. So it must be very clearly spelled out that that is what our role. And the next thing is the auditor is expected to conduct the audit in accordance with the standards on auditing. Accordingly, the letter of engagement should also contain a clear statement that the entire audit will be conducted in accordance with the standards on auditing. And of course, the auditor is supposed to maintain independence and professional skepticism throughout the audit. It is a basic requirement for an auditor. And accordingly, the independence disclosure will also be part of the auditor's requirement. The auditor, in many circumstances, especially when you look at uh, almost all the findings of NAFRA, where they have considered the auditor guilty of professional negligence, you will find the reference to SA 315 and SA 330. SA 315 says the auditors have never assessed or inadequately assessed the risk of material misstatement, or ROMM, very shortly called, risk of material misstatement in the audit of a financial statement. So in other words, if you see that the entire audit is normally conducted based on top-down approach. So understanding the client's requirement, understanding the laws and regulations, understanding the key business drivers and the related risk associated with that. So the risk approach is fundamental for audit planning, audit strategy, etc. So your SA 315 expects that the auditor should consider the risk of material misstatement which may be coming in. And of course, SA 330 says how the auditor will respond to the assessed risk. Okay. These are all the minimum requirement. But in many of the NFRA report, they felt that 315 auditors have not properly considered the risk of material misstatement in many areas, and accordingly, they don't have audit procedure which responded to the assessed risk. Because of this, the basis for their opinion itself is not properly justified, is what the regulators are normally making a comment. So the auditor's responsibility also explicitly mentioned. The moment we talk about our responsibility, we should also think about what is the responsibility of the client. And of course, when we are talking about the responsibility of the auditors, conduct audit as per standards on auditing, it takes care of almost everything. For example, understanding the laws and regulations, uh, considering the risk of fraud in an audit of financial statements, uh, considering the responsibility of joint auditors, considering the responsibility of component auditor, considering the responsibility of the consolidation auditor or the principal auditor, everything comes in, including opening balance verification, etc. So I need not specifically mention about what is the requirement under Companies Act, what is the requirement under SEBI, what is the requirement under all other cases. But a sincere suggestion here is that when you do the audit of a particular entity, and let us assume that it's a listed company, you may have reporting responsibility under the Companies Act, under SEBI LODR regulations. Suppose if that entity is a banking company or a financial institution, RBI regulations also you will be having. All those things also you put forth as part of the legal requirement based on which you will be conducting an audit. So that should also be part of your letter of engagement to consider that. Management responsibility, we have already seen that a precondition for an audit believes that the management agrees their responsibility. So naturally, the responsibilities we have already seen also about preparation and fair presentation of financial statements, internal control for financial reporting framework, providing access to all relevant information, staff, etc. And what we have not considered is on conclusion of the audit or during the course of the audit, if the auditor requires a written representation from the management or those charged with governance, the management should agree to give that type of letter of representation. We have letter of representation when you look at the standards on auditing on letter of representation. It says very clearly that a letter of representation will not absolve the responsibility of an auditor if he has not carried out his audit properly. But at the same time, it specifically mentioned that in respect of certain cases or in respect of application of certain areas, the auditor should necessarily take a written representation. For example, when I do an audit of a client who is dealing with precious metals or gems, the valuation of precious metals and gems as part of the inventory itself requires a lot of technical skills. The auditor may not have the appropriate skill sets, but at the same time, the auditor will be requiring engagement of a specialist and relying on the work of the specialist, and also ensure that the management also confirm their responsibility with respect to the valuation, etc. Okay. But having said that, just relying on the written representation on valuation of inventory will land the auditor into trouble, because the auditor has to do special audit procedures in accordance with the SA 601 relating to inventory. Right. So just relying on letter of representation alone will not help, but wherever there are technical matters involved, where they are, it requires a judgment of certain matters, the auditor will ask for the management representation. In fact, even for SA 240 on fraud risk assessment, how the management got the comfort that there is no fraud risk or the fraud risk has been either prevented or it is going to be, in case if it is identified, it will be rectified, remedial action will be taken over. How the management derives its comfort on the fraud risk areas also. All these things we will be getting letter of representation. So the management agrees that in the letter of engagement, in case the auditor requires a written representation, they will give. Now, as we started with saying, the letter of engagement or the agreement of the terms of engagement should be very clearly documented in writing. We will take some case studies and later on see how things have boiled down to certain problems and the auditors get into some sort of issues because they have started doing their audit without a proper letter of engagement. The basic requirement of the letter of engagement, as we have already talked about, what is the objective and scope of the audit? What is the responsibility of the auditor? What is the responsibility of the management? What is the applicable financial reporting framework under which the financial statements have been prepared and presented by the management? And what is the reporting format of the auditor? And what is the expected deliverables? In fact, certain other matters also we would like to add. For example, in the reporting format and the expected deliverables, you normally say that these are all, we will express an opinion based on our audit conducted in accordance with the standards on auditing, based on the applicable reporting, financial reporting framework. So that's a normal expected deliverable. Apart from that, there could be other matters which also can be accepted, agreed in the terms of engagement. For example, you can also talk about the fee arrangements in case if there are any liability which may arise due to carrying out the audit. What is the limitation of such liability? Clauses can also be added. Sometimes the auditor may require to involve the internal auditors or auditors experts or external experts for carrying out the audit. In other words, the auditor may be relying on the work of an internal auditor, relying on the work of an external expert. So for that, the management should allow the auditor to carry out that. And there could be a possibility that the management may look for a management letter. Management letter, you know that apart from what is the audit report is being given, the auditor as a value addition identifies certain matters which he come across. For example, there is a possible internal control gap, which may be not significant at the financial statement level, but if we allow that gap not being addressed to, it may result in a major issues at a later point in time. Or the auditor may believe that the practice followed by the company may be revisited or re-evaluated in certain areas so that there could be a possible cost optimization, possible avoidance of penalties and fines. And the auditor may also benchmark the performance of the company with the peer group and share those informations with the auditor. So all this could be part of the management letter. The management letter is actually a little bit of guidance for the management on relooking, or maybe I can say that do certain health hygiene relating to their internal arrangement relating to financial reporting framework or preparation of the financial statement, how they can effectively do. So that's the way in which it can also include. The interesting factor is to whom the letter of engagement should be addressed to. There are cases where the letter of engagement has been addressed to the board of directors. The letter of engagement has been addressed to, say, for example, I come across this particular situation. The letter of engagement normally is being addressed to the person who has appointed the auditor of the entity, normally. Okay. Unless there is a delegated authority where the shareholders have said that the board of directors will discuss and agree the terms of engagement and along with the few fees, etc. Normally, that is the way in which the resolution will be passed by the shareholders. In that case, the address may be to the board of directors. In one interesting case, what we have seen is when the appointment of the company has been done by the shareholders of the company, but the auditor could not commence his audit since he could not get the no objection letter from the previous auditor. The issue behind that was basically that the company was having some sort of cases pending before NCLT. There was a petition filed for commencement of corporate insolvency resolution plan, say CARP. The petition was filed, but the petition was not heard, and the previous predecessor auditor was having his audit fees pending. So according to the Code of Ethics, the new auditor cannot accept the audit without getting the no objection from the previous auditor. So the letter of engagement was not even prepared and signed off. And the resolution professional has felt that the new auditor has a responsibility to commence the audit and do the entire audit work, irrespective of what is the outcome of that particular issue. Because there was an interim resolution professional who has been appointed. When this has been discussed to us, we analyzed this entire issue and found out that whether the appointment itself is valid, point number one. Of course, it was appointed by the shareholders, so the appointment is valid. The second is now the board of directors have been replaced, or they have their powers has been suspended and taken over by the interim resolution professional. And accordingly, the reporting authority or the appropriate authority for the company will be now the resolution professional. But at the same time, whether the new auditor can go forward to enter into a letter of engagement for commencing the audit without the no objection from the other auditor. There is two issues. One, SA 210 has to be entered into and the audit should be commenced. The second issue is audit cannot be commenced as per ethical requirements if the previous auditor has specifically not giving a no objection letter. But in that particular case, the no objection letter of the predecessor auditor has mentioned that we have undisputed outstanding fees of so much. The question which has been raised by the RP is whether it is an undisputed or it is disputed. The RP has said that once the CARP proceedings has been initiated, the auditor is also an operational creditor who is unsecured, so he has to file his claim, and the claim will be settled in accordance with the resolution plan. And accordingly, the amount pending is contingent upon what is the outcome of the resolution plan. So the pressure was built on the auditor by RP that they have to agree the terms of engagement and commence the audit. When we had a detailed discussion and looked for a guidance, we discussed that along with the auditor to whom the pressure was made. And we suggested two things. One, committee of the institute, ethical standard board of the institute, because there was a reference under Sikh Industrial Companies Act, previously that SICA Act was there. Under that, if a company fell sick and the previous auditor has not given a no objection certificate, the new auditor can enter into a letter of engagement and commence the proceedings, commence the audit. So whether a parallel can be drawn to such a situation when an entity is under CARP, because CARP may result in a resolution plan where the company will be revived, or it may go for liquidation where the company will be completely non-existent. Accordingly, it is not very clear. So we suggested that better to get a clarity from the ethical standard board as point option number one. And the RP was vehemently saying that why I should get the ethical standard board's view on this. You have been appointed by the shareholders, so you have duty bound to start the audit. And again, we said, okay, the second option which we can say is that since the RP is saying that he has the power to direct the auditor to carry out the audit without having the no objection certificate from the auditor, and he is ready to sign the engagement letter, better let him get the direction from the NCLT itself by filing a miscellaneous petition saying that give the direction to the incoming auditors that they can proceed with entering into the letter of engagement and carry out the audit without getting the no objection from the previous auditor. Okay. So why it is very required is depending on the circumstances, the appropriate authority to whom the engagement letter has to be entered into is also critical as per SA 210. If the auditor misses that point, a lot of times the engagement letter itself is invalid and it cannot be enforced in a court of law, and the auditor may land up in trouble. So that's another interesting factor. This is another question we normally miss out. See, for example, if the auditor is continuously doing the audit of the same client, say, for example, it's a private limited company, the auditor is normally appointed for 5 years, again, another term of 5 years, another term of 5 years, as long as the rotation of auditors under Section 139(2) of the Companies Act is not applicable to the client. Let us assume that is a private limited company where the rotation of auditors is not being applied. What happens? The auditor continues to be with the client for a longer period of time. Whether the auditor required to revise his letter of engagement in a recurring audit, or once he has entered into, say, for example, a term of 5 years, a letter of engagement has been entered into, year on year, whether he has to revise it because it's nothing but a recurring audit. SA 210 gives a very good guidance and application guidance relating to this, stating that in certain circumstances, even though it is a recurring audit, the letter of engagement has to be revised to consider the changes which might have happened in the company. For example, if there is a change in the senior management or the ownership, change in the ownership of the entity, a new management will be coming in, or the new senior management team will be coming in. So their expectation may be different by having a standard letter of engagement format. They might be assuming that the auditor will be doing certain other activities also, whereas it was not explicitly mentioned in the original letter of engagement which has been signed off, maybe in the first year, and the third year or fourth year, there is a change in the management or the ownership. So in that particular scenario, it is advised by SA 210 to go for discussing the scope, and in case if the scope is all right, or the responsibilities has to be whatever is agreed is still continue to be the same responsibility, or is there any scope expansion, etc., including fee negotiation, etc., which may be coming as part of it. So that is one scenario where that could be a possibility. Another thing is, let us assume that, in fact, it happened in my own case, where we were entered into a letter of engagement where the entity was importing goods from its parent company and just selling those products in Indian market, purely a case of trading activity. The letter of engagement and the related risk assessment, etc., was talking about a traded entity. After a particular point in time, almost after our first appointment was over, in the second appointment, in the second year, the management has decided that they will also set up a factory for main manufacturing of those products as well in India itself. And accordingly, the trading activity will be slowly reduced, and the manufacturing and selling activity will be given a thrust. That's what the plan they have in the next 4 or 5 years. They had the business plan. If I simply had the existing letter of engagement, which was customized for a trading company, it may not be suitable for a manufacturing company, right? Accordingly, when there is a change in the nature of business being carried out, or maybe it is smaller entity, all of a sudden that company has become a bigger entity. Maybe it was a startup and it got funding from private equity, and there is, as part of the exit plan, IPO plans have been thought of. So when the size of the business grows also, there could be a possibility of again revisiting the letter of engagement as to the scope, responsibilities, and the agreement. Another possibility could be the legal and regulatory changes under which the particular entity was operating will also require the auditor to revisit certain responsibilities or certain reporting requirement, etc. For example, assuming that your firm, I'm talking about a small and medium practitioners firm, is having less than 4 partners up to the previous year. And this year you have 5 partners. Up to the previous year, you don't have the requirement for a peer review. But after you reached the or crossed the limit of 4 partners, your firm comes under a mandatory peer review requirement as per the directions issued by the peer review board. When you have to give your work papers, all information, financial statement, etc., relating to the particular client, you are actually sharing the information about the client with the peer reviewer or the technical reviewer. So, to that extent, you don't have a straight authority to give that information. Accordingly, in a letter of engagement, we also talk about that the firm is subjected to peer review and other regulatory reviews, and the regulators may ask for the work paper files and other information collected as part of the audit process for review, and the company gives the permission or it is not having any objection in sharing of that information about the company with the regulators. Okay, that should also be part of the requirement. So you have to always look at, up to the last year, I had a letter of engagement, copy paste, sign off in the current year may not be proper, may not be appropriate. So you have to actually see what are all the changes which is happening. Similarly, when the scope of audit is either increased or decreased based on the understanding with the client, and there is a clarity, additional clarity, or the fee which has been agreed is coming up, then it is always preferable. For example, if there is a dispute about the understanding of the scope and the fees which has been agreed previously, the client is feeling that what is agreed is not correct. For example, I have seen very common situation. The fee for audit is rupees, say some lakhs of rupees. It has not mentioned whether the out-of-pocket expenses will be charged extra. It has also not talked about whether applicable taxes will be levied, will be over and above the audit fees. Especially when you are doing services with PSUs or government sector, they believe that the amount of fees which you have talked about is the total outflow for the company. So it inclusive of your out-of-pocket expenses, it is inclusive of the GST element as well. So that could be an understanding which the client will be wrongly having because it was not explicitly mentioned. So if there is a dispute which has happened with respect to the scope of the audit or relating to the fees in the previous period, so it is preferable to correct that by revisiting the letter of engagement in the current period. Similarly, in the previous year audit, you might have come across a lot of misunderstanding between the management and the auditors. And to that extent, to ensure that such misunderstanding is not continuing or such misunderstanding have been eliminated, the letter of engagement is required to be revised in respect of a recurring audit. So the takeaway from this slide is that just because I'm doing the same audit in the current year also, I need not have a letter of engagement is a myth. Let us look at that. I have entered into a letter of engagement for a term of 5 years. As long as that type of engagement letter is there, legally you have a letter of engagement as per SA 210 for 5 years. Absolutely no issues. Even regulators cannot say that you have not revised it on a year-on-year basis. Okay. But if there is any change which has happened, like what we have listed in this particular slide, if you are not revisiting the letter of engagement, there could be a lot of trouble which the auditor may be inviting for himself, right? Including collection of fee itself may be fundamental issue. So that is one thing. In fact, I came across very recent scenario where the client has sent 3 mails. First mail is relating to revision in the scope of the audit during the current period. Of course, this is for internal audit, not for regular audits. The scope of internal audit, because certain areas where we have already reported, they have corrected and they have also automated those processes. So they wanted to remove that. They wanted to add some new scope of areas. The scope has been sent and they asked us whether the scope is okay with us. That is over. The second was relating to another mail which has been sent by the company secretary, where the company secretary has talked about what is the fee for the current year, whether the existing fee will be continued or it will be revised. So we responded saying that we are continuing the existing fee. Sorry, we are not responded, but he assumed that we are continuing with the existing fee. The third mail was there is a specific agreed upon procedure which the CFO wanted to do in respect of some capital expenditure which they have incurred for a project. He wanted to do a deep verification of the entire thing, including how the process of selection of vendors have also been done. It is expanded scope. And this procedure, we had a discussion orally with the management as well as the CFO that it will be a separate assignment because it's like an agreed upon procedure, not part of the internal audit. We will be issuing an agreed upon procedure report. All those things has been specifically agreed. Interestingly, in the third mail, the confirmation which came from the CFO is that we are thankful for the scope you have agreed upon, for this, including verification of the project expenditure incurred, as well as that there is no change in the audit fees compared to the previous period. So the client's misunderstanding is that with so many things we have agreed, he was having a feeling that we are going to do the audit at the same fees because company secretary was, he presumed the fee and he has communicated to in his mail like that. So the CFO has felt that, oh, maybe the auditor has agreed to continue to do the entire work with the same old fee. The first thing which we have done is we have mentioned, sir, we are not yet entered into letter of engagement. As per our discussion, these are all the things which is going to be scope increase, and accordingly, this will be done as part of internal audit, and this will be done as part of agreed upon procedures. And to that extent, the fees is for internal audit is different, and the agreed upon procedure is different. Then the CFO was very clear, and he went to the management. Management has said that was we have agreed. So it was cleared. So why I am saying that is sometimes when some presumption or assumptions are happening in the course of the audit appointment or during the course of our audit, there could be certain things which the auditor may be looking for explicit inclusion for in the letter of engagement, so that even in the recurring audit, there could be a need for revising the letter of engagement. So then, suppose if there is a change in the terms of engagement, whether there is any guidance which is available in accordance with the standards on auditing SA 210. See, for example, I have already entered into a letter of engagement. It was signed by both the parties. And now the management wanted to change the terms of engagement. Whether the auditor should agree with the changes in the letter of engagement. The first point is as far as the audit is concerned, because it's an audit, and as far as the audit is concerned, audit engagement is concerned, the scope or the terms of engagement is more or less straightforward. It also talks about the financial reporting framework, the laws and regulations applicable, what is the reporting requirement, etc., etc. Let us assume that the management wanted to change the terms of engagement by saying you should not ask for confirmation from certain customers of the company. Specifically, many of us might have come across this situation. SA 505 requires you to get external confirmation, and the entire process of selection, sending, receiving, reconciling that with the books of accounts and drawing the conclusion of that is with the auditor, right? So SA 505 expects you to send the uh, the request for external confirmation, and when the auditor selects the sample out of the total trade receivable to whom he wanted to send, it is his prerogative. It is based on his judgment, based on his experience with the client, based on the audit risk assessed with respect to the particular client, and based on the responses which he has got in the previous year. With the collective knowledge, the auditor decides to stick on to a particular sample size. But when I decide that I will be using a sampling technique, the fundamental principles of sampling is that each of the items in the population should have an equal chance of getting selected. Then only considered as a proper population, right? So if the sampling makes it differently, saying that only certain items will be selected, certain items will not be selected, it is not a proper population and proper sampling technique, because based on what I have observed as identified misstatements, I will be projecting on the untested population as well. That is the reason why it should be a representative sample of the entire population. So each and every line item in the population is having a chance of getting selected as a sample. So it may be based on the auditor's judgment. It may be a random sampling, scientific sampling. Auditor may go at a disaggregated level. The auditor may think about using stratified samples. Auditor may be thinking about covering top items first, and then balance he can do the statistical sampling for the other items. The entire thing was based on the auditor's point of view. If the management says, with respect to the trade receivable, this is the trial balance, but we will mark some 25 customers to whom you should not send any confirmation request. We will not allow you to do that. Okay. So in saying that, sir, you have already given a letter of engagement where you said unrestricted access to records and information. Now you are saying that these parties should not be approached for external confirmation. So to that extent, there is a scope limitation. And accordingly, the change in the terms of engagement, if the client says, okay, yes, there is a scope limitation, you put it in the terms of engagement. But the guidance given in SA 210 says, auditor should not agree to such a change without a proper justification. Let us take one example. For the external confirmation itself, let us take a case. where, as per the external confirmation requirement, SA 505, uh, sending confirmation request to trade payables is not mandatory, but it's a preferred method because you will totally avoid the risk of material misstatement arising from trade payables with respect to existence of the liability, etc. So naturally, you will normally look for external confirmation even for trade payables. Even regulators asking why you are not circulated to the payables, the suppliers. But in one case, there was a requirement. Let us assume that there are some 5, 10 parties with whom there is a dispute going on. And the moment the auditor sends a letter of external confirmation, request to external confirmation, where it states that the balance as per our books of accounts as on so and so date is so much. Please confirm. If you are not agreeing with that, give the number as per your books of accounts along with the statement of account. This is a normal way in which external confirmation will be drawn. So the management is making a request to the auditors saying that these 5, 10 parties, we have a litigation going on. Accordingly, the balance as per our books, if we are sending as part of the confirmation request, they will take this as an evidence in the court of law, which may be unfavorable for the company. As far as you are concerned, these parties are under litigation for the past several years. The same balance is continuing, and you have also gone through all the correspondence that there are litigations with these particular parties, and accordingly, why you wanted to send the confirmation again. So don't send the confirmation for these 10 parties. In this case, it's a scope limitation agreed, but at the same time, whether there is a justification in this request, the auditor has to exercise his judgment, exercise his experience, professional skepticism, based on which the auditor may conclude. In case if I have been asked to do that, I will conclude because the balance never changes, and I got confirmation of balance on 3, 4 years back, and the litigation continues to be there. And if I am asking for a balance confirmation at this point in time, it may be unfavorable for the company. So accordingly, I can restrict myself. But what the auditor is expected to do is the auditor is expected to bring out this scope limitation if he is not able to eliminate the risk of material misstatement through alternative procedures. If external confirmation, when it is not received, you have to look at the alternative procedures according to SA 505 to get the comfort on the particular balance. If it is not being done, the auditor naturally has to think about modifying his opinion, right? SA 705 requires that to be done. But when there is a justification for a change, the auditor can agree for change in the terms of engagement. But at the same time, when there is a change in terms of engagement which has been requested by the client, the auditor should also evaluate whether the new engagement letter or the terms of the new engagement letter will be consistent with the overall objective of the original audit engagement. One or two areas where judgment can be exercised. Suppose the entire audit objective itself is being derailed by entering into a change in the terms of engagement, the auditor should not agree for it. So he has to evaluate. And the auditor should document the reasons for the change in case he has agreed for that. And a new engagement letter is required. Some people believe that can I go for a codicil or a supplemental terms of engagement where we say these clauses have been changed. All other clauses of the engagement letter will remain same as per the original engagement letter dated so and so. My suggestion is preferably enter into a new full-fledged engagement letter covering all aspects and supersede the existing letter of engagement. That is a preferred method wherever there is a change in the terms of engagement is requested by the client. There are certain scenarios where the auditor has to withdraw from the engagement. I've entered into a letter of engagement, so I cannot withdraw from the audit engagement. You cannot make that as a justification for continuing in certain audit. There are cases where the regulators have come across scenarios where the auditors have said that we cannot withdraw from this engagement, so we continued with the engagement because of letter of engagement already signed. Need not necessarily be. Let us consider two aspects. One, whether the auditor can withdraw from his engagement in all circumstances. Let us look at that. And the second is, what is the requirement in case if the auditor withdraws from the engagement, which has been already supported by a letter of engagement. If he is withdrawn, what are all the responsibility the auditor has? Two sides of the coin, let us see. First of all, the letter of engagement has been made based on certain preconditions which must exist for an audit. Then only the engagement can be carried out by the auditor. If the preconditions of an audit is not met and the auditor observes during the course of the audit, the auditor will be entitled to withdraw from the engagement. Point number one. Point number two is, as per the engagement letter, the auditor should have unconditional or unrestricted access to information and staff of the client to carry out his audit responsibilities. If the management imposes certain unreasonable limitations, the auditor, if he believes that this is not, he could not obtain sufficient appropriate audit evidence, or he cannot form a basis based on the limitation which has been introduced, and the management is also not agreeing for a modified opinion as per SA 705, the auditor should withdraw from the engagement in accordance with SA 210. Suppose if the auditor believes that there is no basis for any new engagement because the existing engagement itself is not meeting the preconditions, etc., at the time also the auditor can withdraw from the engagement. Having said that, this is part one. Part two is whether the auditor has any responsibilities when he withdraws from the already agreed letter of engagement and not perform his audit duties. What are all the responsibilities? You might have seen that previously the audit resignations are a straight form filed with the Register of Companies. The MCA website has an e-form. It is a straight process for any resignation of an auditor. But now, if you withdraw from an audit engagement without completing it, and your resignation should be supported by the reason or justification from withdrawal from the engagement, should be very clearly mentioned. And if the MCA believes that your reasons for withdrawal are not acceptable, they may force you to continue as an auditor and complete the audit. There are cases where the auditors have filed their resignation letter stating that they are preoccupied. The Registrar of Companies or the MCA has told that at the time of accepting the audit, you have never felt that you are not occupied. But now you are saying you are preoccupied. That means you are trying to escape from the engagement completion. So they said that it's not possible. There are cases which you might have seen that the auditors during the audit rotation period agreed the audits left and right. And before 1 year is over, they wanted to resign from the audit. In that case also, MCA, ROC, and SEBI has come out heavily on the auditors who resigned without completing their activity and directed them to complete their responsibility as an auditor. Even qualified opinion is fine, but you have to complete your responsibility and then only you can withdraw from the engagement for the next year onwards. That is the way in which the regulator felt that the auditors cannot simply move out of that. Having decided to withdraw from the engagement, in those circumstances, which is permitted as per law, the auditor should, permitted by law as well as standards on auditing. For example, when the preconditions are not met, it's standards on auditing. When management imposes unreasonable limitations, scope limitation comes as per SA 705. In those circumstances, the auditor is entitled to withdraw from the engagement. He need not continue in the engagement, but the auditor should very clearly document the reasons and communicate those reasons to those charged with governance. In some cases, when the auditor says, due to preoccupation, we are withdrawing from the engagement, those charged with governance might have accepted, but it might have it actually landed the auditors into trouble where the regulator have said that this is not acceptable attitude. In fact, I can take one simple example, a case study where one audit firm has filed the letter of resignation with the MCA website, stating that the audit risk which they have assessed at the time of accepting the audit significantly increased when they were going in the field and doing the audit, and accordingly they believe that their audit, the preconditions relating to the audit which was agreed at that point in time, was not existing during that course, and accordingly they wanted to withdraw. That is a justification, proper justification. Because the risk element has increased according to my firm's acceptance or continuance of an audit engagement beyond the certain threshold limit, the risk assessment or risk management partner does not allow me to continue in that engagement. Perfectly justified. But MCA has not stopped with that. MCA has come out with a simple observation saying that you have agreed this audit in the beginning of the year, and you have carried out limited review for almost 3 quarters. Even though it is a limited review, you have not carried out full audit. But even for limited review, you are supposed to assess your risk of material misstatement. Then only you can carry out your queries with the your questions with the personnel of the entity, and then corroborate the answers received with the actual audit evidences collected. So it is only not a reasonable assurance, but moderate assurance you have given in 3 quarters. And you are now saying, I'm carrying out the audit only in the last quarter, so I wanted to withdraw because my risk assessment has significantly increased than what I have originally planned at the time of acceptance of the audit. MCA has not agreed. So the auditor has been forced to continue with his engagement. And of course, the auditor has given a modified opinion. That is different aspects. So when you wanted to withdraw the engagement, now you should also look at the practical scenarios of law and regulations, which is prohibiting the auditors withdrawing at the last moment of an audit without discharging their attest function. So that is also you have to look at as part of your engagement. Every standard, as you talk about, will always come with an application guidance. So one portion of the standards on auditing will be the standard, and then you have the application guidance. The paragraph number will start with A11, A12, like that, A1 to whatever number it starts. The application guidance given in the standards, normally people or even the chartered accountants have not spent much time in going through the application guidance. But being part of WASB many times, even the current period, I must reiterate or emphasize that please look at the application guidance of any standards on auditing, because that gives you enormous guidance of how to proceed in a given situation, and also ensures that all the practical issues have been taken care. Apart from that, now Institute is also taking up the possibility of coming out with the implementation guidance also. Not only the application guidance, the implementation guidance note also. They are planning to come out with, and they have also come out with certain guidances like that, wherever they felt that there is some more clarity has to be brought in. My suggestion is, please look at the application guidance section of the standards as well. When I look at the application guidance side, I'm looking for how an engagement letter can be drafted. Preferably use a standard template for engagement letter across the firm. I use the word across the firm. But this standard template which you are using, why I am saying across the firm is, the firm level SQC1, standard on quality control, has to be maintained. How they carry out the audit, how they accept an audit, how they continue the audit engagement, etc. There is a procedure which they have to follow. So the acceptance and continuance process also part of SQC1 process, right? Similarly, your at the engagement level, when we were talking about the quality control also, standards on auditing specifically prescribes certain things to be done. Accordingly, across the firm, if you start using a standard template, it will not create any confusion among the audit staff members. Standardization is always helpful for a simple reason. Whether I issue a report here or I issue a report in my Delhi branch or in my Mumbai branch or in my overseas branch, whatever we are taking as an example, if I have a standardization in my reporting format, reporting requirement, communication with those charged with governance, it is more or less like a simple spoon feeding method to my team members to efficiently and effectively conduct the audit. So very clear guidance I am providing. Second, when you use a standard template, you will always cover the areas where it is required to be covered as per SA 210 in full. And accordingly, the use of standard templates for engagement letter is a preferred way of doing it across the firm. Having said that, SA 210 is not simply saying one size fits to all. It says that tailor those standard template letters to the specific industries or specific requirement of the client or specific risk associated with that particular audit engagement. So standard template starting point. If it is a straightforward case where the audit risk is low, where the engagement is for a manufacturing company, I have a standard template. For a trading company, I have a standard template. For a service industry, I have a standard template. Let us assume that all the engagements which I'm doing is no complexity in accounting. They are straightforward. The audit risk assessed by me is also relatively low. Then in those circumstances, my standard template with the corresponding change in the reporting authority as well as the name of the client, year, etc. If I change, that is fine. But in specific circumstances, you should always evaluate whether the standard templates has to be customized for the given situation. Some firms where they can afford create standard templates according to specific industries, which may have specific risk also. One of the SQC process which we follow is that we have the tailored letter of engagement for industry wise and type of the client wise, where the audit risk is low, medium, or high. We have that template. But at the same time, what we say is that if you are trying to change or customize a letter of engagement for a particular client, the engagement partner alone or the engagement manager alone cannot decide on the format. They have to get the approval from the risk management partner to review that particular standard template to ensure that all the requirement of the standards on auditing 210 has been properly complied with the customization process done by the that particular concerned audit partner or audit manager, as the case may be. This is one of the SQC process. So wherever it is, the firm can afford to do that, they can do it, or otherwise, preferably one partner when he prepares, let it be vetted by another partner. That also you can think about doing it as part of the application guidance. Wherever scope limitations have been made, the letter of engagement should talk about the scope limitations explicitly, and it is not enough in the auditor's judgment or auditor's experience, what could be the possible implications of that scope limitation should also be mentioned in the letter of engagement itself. The reason is, on seeing the possible implications of the scope limitations, the management or those charged with governance may think removing the scope limitations if it is going to affect the fair presentation of the financial statement. Okay, it is not in accordance with the required financial reporting framework or whatever. When they are made aware of the implications, there could be a possibility of somebody rethinking their assessment of lifting the scope limitation. And the best guidance, which I believe in SA 210, is that like in every other standards and auditing where documentation is important, here also it says maintain documentation of all the communication with the client. Right from the initial consent letter being issued for consideration of appointment, receiving the appointment, sending the getting a no objection certificate from the other auditor, and then entering into the letter of engagement. Letter of engagement has been properly drawn up. And if there are any scope limitation, the client was mentioning how the scope limitation will result in maybe in an adverse opinion or a modified opinion. All these things, whatever communication which has happened, properly should be documented as part of your audit file. That is also a proper guidance, which actually relieves the auditor from a lot of possible litigations at a later point in time. So having said that, I pick up certain practical issues in implementation of SA 210. The auditor prepares the letter of engagement, sending it to the management for confirmation of the draft, because management will be insisting on a draft letter of engagement where they wanted to vet. But in some cases, bigger clients' case, they have a legal department which will vet that type of confirmation because it's almost like a contract, right? They vet and they may suggest a different language. For example, in one of the client case where we have mentioned that our firm is subjected to peer review, and accordingly, our work papers may be required by the regulator. We added the standard clause in the letter of engagement. One new client to whom we have sent it for the first time, he said their legal department is saying that by allowing others, they are considering others includes the regulators also, others to have the information about the company, the confidential information about the company may be disclosed to third parties, and accordingly they don't want it to have that particular clause. They wanted us to delete that clause. So what we have done is we have specifically mentioned that, or maybe I must say in a different perspective, I have taken a classroom session of the entire peer review process and what is the reporting which is going to happen and who will be reviewing and what is the confidentiality clause that reviewer is actually signing with me, etc. We have said, and based on which peer review process I cannot avoid. It is a mandatory process for a practicing unit, and accordingly I cannot avoid. Then also they are saying that is it any possibility of avoiding this particular wording? We said that if we have to avoid this particular reference, then I should say that I cannot accept the engagement. Then only they have analyzed this and they have agreed for it. So there was a delay in management confirmation, but at the same time, there could be a problem to meet your timeline for deliverables. Say, for example, what I have mentioned to you now, when no objection certificate was not received relating to a SARP company, the audit acceptance itself has taken a long time, and accordingly, entering into a letter of engagement has also taken a long time. If I am not wrong, that a particular auditor has actually done 7 quarterly review and 2 audits on a continuous basis. Every 15 days, 1 quarter is finished. The accounts has been adopted and then filed with the regulators, and then it was moved on to the next quarter. Like that, almost for nearly 7 quarters and 2 years it has been done, is what I heard from the other auditor, because of the delay in confirmation by the management in getting a proper letter of engagement. Could be a possibility, but yielding to the pressure for the timeline should not compromise the audit quality, because ultimately we have the overall responsibility for our attest function. Second is responsibilities they don't wanted to openly acknowledge. The management responsibility should be acknowledged by the entity in the letter of engagement. Management may believe that they don't want to acknowledge the responsibility, stating that anyway, you know that why should we explicitly acknowledge this responsibility? So we should make them understand why this is required for a simple reason. What is required as per the requirement of the law, and why we have to get this information, etc., is very, very required to be done. This is second. And because the scope is not very clearly mentioned in the letter of engagement, because the documentation is not well drawn, there could be a possibility of what auditor's responsibility, what management responsibility, what is the areas to be done. All those things could be becoming ambiguous also. So that could be another practical issue which may arise out of a lack of proper letter of engagement. Another issue which we have seen that in progress. See, for example, let me say that I'm doing the audit of a listed company. So I have entered into the letter of engagement in the initial stage, where we have said that we will be issuing a report under the Companies Act. We will comply with the requirement of SEBI listing agreement. We will also issue a separate report on internal financial controls or financial reporting, etc. We have entered into that. Let us assume that first 2 quarters there is no change in the law, but the third quarter, the SEBI listing agreement has added additional responsibility for the auditors. And to that extent, what was originally entered into may not hold good. And if I have not revised the letter of engagement to update it according to the new legal requirement, it may be inadequate. And it may result in regulatory issues for me as well as an auditor. So accordingly, the auditor should always watch what are all the legal requirements or changes in the legal requirement which is happening throughout the year, and whether it warrants for a change in the letter of engagement already executed. They are a majority of the circumstances, if it is missed out, you will get into some sort of problems. This is also another scenario which we have seen. And of course, some of the regulators report also has a feeling or presumes that if the auditor has signed an audit report, he is also certifying there is no fraud which has taken place and it doesn't have an impact on the financial statement. 100% auditor is certifying that there is no fraud at all. The regulators are missing, the client is also missing one point, that the auditor is expressing an opinion which is a reasonable assurance. And in doing a reasonable assurance, there is a paragraph which explains that where the auditor uses all the audit procedures in accordance with the requirements of the standards on auditing, there could be a possibility of certain mistakes or errors could not be identified through the audit process, and the audit opinion could be issued without considering that. Basic reason because of basic reason behind that is there are always limitations as to the audit function, because the auditors are not carrying out an audit 100% of the population, not possible. So that is the reason why they go for a sample check, test checks, etc. So when I do a test check and forms my opinion based on the samples I have validated, subsequently, if there is a fraud in respect of another document which was not falling into my sampling, the regulators are feeling that auditors have missed out or auditors are professionally negligent to carry out their responsibility. Accordingly, nowadays, what client is insisting that, sir, as an auditor, you should also detect the fraud. And if there is any issues later on identified, you should be held responsible for the losses which the company is making. So this type of arrangement, the auditor should never ever agree. Because if you see the standards on auditing, it makes it very clearly an orchestrated management fraud cannot be identified by any audit tool. That is what very clearly mentioned international level also. If you look at certain judgment which has been made, they make it very clearly because of the limitations. I do test checks and sampling. It is not 100% is not tested by me. And another thing is the auditor's limitation is also that when I look for an appropriate audit evidence, the audit evidence is not a conclusive evidence, it's only a persuasive evidence. Conclusive evidence means it very clearly says that this is the balance. And in some cases, I get the audit evidence, which makes me to rely on my judgment, my professional skepticism, my experience, etc., to consider whether I can put reliance on the audit evidence to conclude that this is the basis on which I can say this account balance is correct or not. Okay. So when the auditor's judgment plays a role and the always conclusive evidence, but it's only persuasive evidence, auditors cannot enter into such a type of confirmative letter of engagement. But if the client is insisting on that, you should always say that the client is supposed to put in an internal control system which prevent and detect fraud when it has occurred. So that is the responsibility of the management first. I'm only going to consider the fraud risk in my audit, but not looking at the audit to identify fraud, because it's not investigation. Investigation is different and audit is different. The auditor should not agree with that, but sometimes this type of I should say, the client has thought that this is also auditor's responsibility, may make that undue request or undue expectation, build an undue expectation from the client's perspective. But auditor should talk about SA 240 in the letter of engagement. What is their role relating to fraud? Okay, that should also be part of that. That is one practical side of issue. This is one thing which I have already told, right? The auditor continued the audit for 5 years without reconfirming the engagement terms. And there are some changes which might have happened during that period, which is not properly taken care. That is the reason why we always wanted to see what are all the changes in legal framework, in audit risk, in our scope of the audit, etc. We continuously monitor and revise the audit letter of engagement. This is another thing which I have seen. Majority of the disciplinary committee proceedings are based on this. The letter of engagement is accepted with the client, and the auditor has commenced this audit. Maybe sometimes, even before the letter of engagement has been signed off, the auditor commences audit. For what? Second is, he is waiting for no objection letter from the previous auditor, but even before that, he has entered into a letter of engagement and started the audit. The date of the letter of engagement has become an evidence in disciplinary proceedings saying that the auditor has not got no objection certificate from the predecessor auditor to commence his audit. That is considered as one of the negligence as per the ethics requirement, right? In fact, I have seen a case where the predecessor auditor has resigned on 27th of September. And not even 27th of September. The no objection letter, actually he has not resigned. In this case, it's a different scenario. That is a better example for us to understand the gravity of situation. The no objection letter received from the new auditor to the predecessor auditor was on 29th of September. The financial statements have been signed on 30th of September. So letter has been received by the predecessor auditor on 29th. Financial statement has been signed on 30th. Let us take that into two different aspects. One, let us assume that this letter of engagement has been, instead of 29th, this NOC letter has not been sent on 29th. It has been sent on, say, for example, 22nd or 23rd. And the financial statement has been signed on 30th September. We take one example and then come to 29th and 30th. 23rd to 30th, 7 days has been pending. So for the 7 days, the new auditor has waited for the confirmation by the previous auditor, and then he has started his audit and completed his audit. Let us assume that after 7 days, he has finished the waited and then started his audit. The question is, I waited for 7 days. That means 23rd to 27th, 29th or 30th. How it is possible for me to carry out the entire audit and complete it within a single day? Not at all possible, right? Similarly, when 29th I have received a letter of request for no objection, on 30th they have signed. They have not even given the due time for me to respond, or maybe time was not given to the previous auditor to respond. Without that, you enter into an engagement letter and started working on this. And in one scenario, the letter of engagement date was even before the communication to the previous auditor asking for no objection letter. That means you assume that I will accept the audit, I will proceed with the audit, but at the same time, the previous auditor has not yet confirmed it. But some clients may ask for a letter of engagement to be signed before you get a NOC from the auditor. That could be another practical issue. Before coming to the third part, let me just see these two parts. In both the scenarios, it will be very clearly proved that the audit engagement has commenced even before NOC has been received from the previous auditor, and the chartered accountant has been held responsible under the ethical requirement of the Institute Code of Ethics has been violated. So we have to be careful whenever there is a change in audit and we are getting an audit appointment in the place of another auditor. never ever accept the pressure of the client to sign up, right? And the third aspect when we were talking about is that the auditor who has been appointed under government notification has not seen the reporting requirement under the legal conditions. For example, let me assume that simple example which we can take out is assuming that you have been appointed as the auditor of a PSU. In a PSU, since the appointment came from C&AG, a lot of auditors are believing that no letter of engagement is required. We can straight away go and do the audit. But what is important is you should have a letter of engagement talking about the normal audit requirement as per SA 210. Apart from that, you should also talk about your audit may be subject to a supplemental audit by C&AG, and to that extent, you will be sharing all the work paper files, all the information with the C&AG as well. Could be a possibility, right? And accordingly, ignoring that legal reporting framework will also be an issue before on doing this particular aspect. So, in the implementation of the letter of engagement, we have to be careful with respect to ensuring that we are not jumping to any conclusions in starting an audit without a letter of engagement. Next, certain complexities may come in. And again, guidance is available for entering into a letter of engagement as per SA 210. The application guidance portion gives you a lot of guidance. Let us take some 2-3 scenarios. One is a joint audit. So, is with respect to the joint audit, whether the engagement letters should be signed by both the auditors separately, or they can get a joint engagement letter. There is no specific or explicit guidance. It can be separate or it can be joint according to what they have decided and how the client is ready to accept that engagement letter. But what is required is very clear explanation of the areas divided by the joint auditors as their scope of work during the particular year should be very clearly spelled out in the letter of engagement, as well as they are supposed to communicate the engagement with those charged with governance. There also the division of work has to be communicated with respect to joint audit. Coming to group audits, there is one position which is not very clearly coming out, because we have a standard called SA 600. It says that if I'm going to sign the audit report of a group or maybe a parent company which has branches, etc., or it has subsidiaries, etc., how I have relied on the work performed by the component auditor. Component auditor may be branch auditor, component auditor may be the auditors subsidiaries, associate, etc., which has been used for my used for the consolidated financial statements, and where I have expressed my opinion on the consolidated financial statements. SA 600 is talking about that. One of the paragraph in SA 600 makes it clear the principal auditor or the parent auditor is responsible only for the areas he has carried out or where he carried out the audits, and he can place reliance on the work performed by the component auditors. And if something wrong in the component, the responsibility is lying with the component auditors and not with the parent auditors or the principal auditor. This is what SA 600 says. ISA 600, International Standards on 600, says that the overall responsibility lies with the principal auditor, and even if something wrong in any of the component, the parent auditor will be held responsible for not reporting that particular area as well. So the scope is automatically getting expanded like anything, right? Because where I have not even understood what the other auditors have done, how I will be able to do that. So previously, the position taken by SA 600 safeguarded the interest of the practitioners, but ISA 600 was having a different proposition. As far as the audit conducted under ISA 600, I cannot have any other escape route. I have to be held responsible for the entire financial reporting. Okay, but now the position has been taken based on one recent review done by NAFRA, where the parent auditors have said that the issue has actually happened in one of the subsidiary, and they are not auditors of that subsidiary, and accordingly, they don't have any responsibility, or they cannot be held responsible for the wrongdoing of the component, and it is the responsibility of the component auditor. So to that extent, they have actually filed their objection and went on an appeal also. Enough were saying that the overall responsibility lies with the principal auditor. They have used that as a guidance where the company is listed or coming under the purview of NAFRA. Okay. The dispute is still going on whether we have accepted or not accepted, etc. But you must understand one, as far as the group audit is concerned, because of the complexity involved about their overall responsibility, preferable to have a continuous communication with the group component auditors by the group auditor. In other words, right from the planning stage to the completion stage, the entire work of the component auditor should be subjected to the review or monitoring of the principal auditor. Unfortunately, in our framework, we cannot ask for the work papers of the component auditors. We cannot give directions for them. But on a go forward basis, if there is a component auditor and I'm the consolidation auditor, I must specifically tell the management that unless the component auditors agree with this group audit instructions and follow what we are saying, it will be difficult for us to do the audit. If the group component auditors say trying to take the shelter under SA 600, then the pressure will be coming from the parent auditors or the principal auditors saying that then we will do the entire audit, remove the component auditors and give the entire thing to us. Problem will be twofold. One, there could be a lot of loss of opportunity for the small practitioners, could be a possibility because of this concentration of audit may happen. That is one issue. The second issue is, even if concentration is happening, whether there is a bandwidth available for the parent auditors to carry out this audit also an issue. So accordingly, when you draft the a letter of engagement, consider this implications, consider this nuances, consider this complexities which is coming out in the landscape of audit to safeguard your interest. First time audit, when you are accepting an audit, lot of requirement is required. The documentation itself is extensive because you have to do audit of the opening balances. You cannot simply say that I have relied on the work of the previous auditor. And you have to get a no objection by the previous auditor. If the previous auditor has issued a modified opinion, how you have considered those modified opinion or basis for the modified opinion in your audit strategy, audit plan, how you have considered that as mitigated. In fact, I come across personally one such issue. The previous auditor has actually qualified about the approval relating to related party transaction. The related party transaction, that being a private limited company, there was a requirement as per the shareholders agreement. Any related party transaction should be approved by both the parties. even though the other party is minority shareholder or non-controlling interest, still they should also approve that. It was a condition in the shareholders agreement. That shareholders agreement has been cancelled due to that minority shareholder wanted to start his own business in the same area. So he doesn't wanted to have an Indian partner. So he has started his own. That has happened in that particular situation. So, but when the accounts has been prepared and it has been sent, the previous auditor has qualified on approval of the related party transaction. When we have evaluated whether it requires a qualification or not, we have considered all the circumstances and decided that qualification is not warranted for the related party transaction. There are other qualifications which we continued, but this related party transaction approval is not required because the shareholders agreement which formed the basis for that is not there. But the board has already approved the related party transaction. Interestingly, the entire financial statement is also signed by the other shareholder, but still he has said that the related party transactions are not agreed by him. So you have to be cautious about all these aspects when you enter into an engagement letter, because the areas where you wanted to do the audit required to be customized to address the possible risk of material misstatement. And when you wanted to drop your qualification, what type of activities you wanted to do, what audit evidence you wanted to collect, also very, very important for you to do that. This is another area, especially bigger companies, that this comes as an issue. What happens is the accounting function is outsourced, not outsourced to third party. So when you are doing an audit, they will simply say that the entire accounting function has been outsourced. So you have to work with that outsourced party and carry out your audit. When you go to the outsourced party will say, I'm not maintaining accounts only for this particular client, I maintain for another 1,000 clients. So I cannot give you the access to all my facilities. That could be a possibility. So whenever there is an outsourced accounting function, you must make the access requirement defined very, very clearly. In fact, there is another standards on auditing which talks about using the work of what is that? Sorry, I will come back on that. It is talking about a service organization, using the work of a service organization. If you are your client has engaged a service organization, you have to do the audit of the service organization also. The guidance was very clear. So if you follow those guidances and ensure that if you follow that guidances, you will understand that access to information, access to the internal control system tested at the outsourced service organization is also important. And that is the reason why when they are doing this for many clients, they go for a specific certificate or audit, type 1 certificate or type 2 certificate they collect as per what is it, SAE standards on assurance engagement, and then they get this and give that certificate. To that extent, you can rely on the control aspects when you have to issue an report on internal financial control or financial reporting. In fact, this particular issue has also resulted in a lot of qualification and audit trial aspects, where the access to the edit logs maintained by the outsourced accounting function was not made available. The auditors have actually expressed their inability to confirm whether the audit trail is properly maintained or not. Of course, we have also seen diversified views. Same outsourced function is used by two different companies. One company's auditor has given a clean audit opinion. The other company's auditor has expressed his inability to comment on that. But it all depends on how the auditor has actually carried out his audit function, how the audit evidence he has relied upon. But in this type of circumstances, be careful, because if it is being utilized by some other customers, how the other auditors have reacted to the activity also important for you to form your own opinion. So that is some complexity which you are supposed to look at. Some missing pitfalls, which I have almost talked about that. Common pitfalls I observed by the regulators. One is engagement letter is not there. Boilerplate letters have been made, but not tailored for the client. Preconditions, whether existent or not existent, is not properly assessed. And management responsibilities is not explicitly stated. Client has not signed off. I sent the draft, client has never returned it, but still I have started doing the audit. That is also another issue which they have formed. Is also happens. The client puts a time pressure for completing the audit, and the letter of engagement is signed delayedly. So I have commenced the audit before and getting into trouble at a later point in time. Undocumented scope limitations. Orally, client is saying that don't do the inventory observation, don't send the bank confirmation letters, etc. So those areas is risky, common pitfall where auditor yield to the pressure. And after the engagement letter has been agreed, signed off, client verbally requesting for additional work to be done, and where there is no additional scope of fee which has been agreed. In such a scenario, auditor should either revise that or specifically get a confirmation for the extended scope of work. So the quality review observations is also on these lines only. Lack of signed engagement letter, no evidence of management agreeing the terms, changes in terms has not been documented properly. They are saying that due to engagement flaws, audit planning itself is not properly done. It's inadequate is what the regulators have expressed as concerns for that. So their expectation is clear document of audit and client understanding. Engagement letters are aligned with the standards in auditing. Specifically, scope, responsibilities, or limitations have been agreed upon and explicitly stated in the letter of engagement. Evidence of professional judgment in difficult scenarios supported by the management representation letter is also documented properly is the expectation. So what is the recommendation for compliance? SA 210 checklist, please prepare and ensure that it is being followed by each and every for each and every engagement. Continuously do the training on engagement procedures for team members, including staff, engagement team members, administrative staff, management, engagement partner, engagement manager, etc. You have to do it. Proper audit file index for engagement documentation is also required. So automated process is now becoming easy for every client, whether you have got the engagement letter signed and what is the date of the letter, when you have commenced, etc. You can document it. Before audit starts, please ensure that the engagement letter has been done. So some case scenarios which we have done that audit begins without signed letter, results in fee dispute. Letter has been signed but does not reflect changes in accounting standard. Created in mid changes, we have said that we have already discussed that. Group audit fails to define the scope of the component auditor. SA 600 issue came in. All those things are possible issues which we have seen because of inadequate or improper letter of engagement has been signed. The key takeaway from this session, according to me, is that SA 210 is foundational for the audit integrity. Foundation stone for commencement of the audit, carrying out of the audit, ensuring that you don't land up in trouble. Engagement letter is also the roadmap for the entire audit. So scope issues, legal risk, regulator criticism can be totally avoided if we have a proper engagement letter. Proactive communication and documentation is critical with respect to a letter of engagement. That brings me to the end of this session. What I will do is I will stop sharing my presentation and see whether there are any questions which I will take up for maybe another 5-10 minutes max.
Yes, sir. Thank you, sir, for this informative session, sir. So today we have joined by more than 1,300 members, sir.
Oh, thank you so much. Thank you, members.
And Sir, during the session, we have received some questions from the participants. So
Yeah.
I request you to please take these questions.
Yeah,
Sir, I will read the question and also put the questions in chat box.
yeah.
Uh, Sir, the first question is
Yeah,
an
I will read this. An NGO client which previously followed cash-based accounting has shifted to accrual-based accounting from the middle of the financial year. As an auditor, how would we address the change while agreeing to the terms of the audit engagement under SA 210? What factors would you consider before accepting or continuing the engagement, and how would this impact the contents of the engagement letter? When I say applicable financial reporting framework, if you find that the cash basis of system has been made to accrual basis of system, the entire presentation and disclosure of the financial statement will undergo a major change, and accordingly bringing that aspects into the letter of engagement and revising the previously signed engagement letter will be the easy way of addressing this particular issue. Yeah.
The next question is related to this.
During the year, a new CFO joins the company, a client entity, and raises concerns over the scope and fee that were previously agreed with the former CFO. Under SA 210, or we need to revise or reissue the engagement letter. What steps should you take to maintain clarity and professional safeguard? As you have seen that the revision in engagement letter, one of the consideration has been considered as change in the key management people also. So that means if there is a change and the CFO is actually challenging the scope of the audit, we should revisit whether the scope of the audit is in accordance with the requirement of the applicable financial reporting framework, the laws and regulations applicable to the entity, and what is required to form the basis for issuing our opinion. So these are all the aspects which we have to consider. If there is an undue expectation from him, then we have to say that it may not be possible for doing it. We have to go to the uh, next level of management, that is those charged with governance, make them to understand, because CFO is only one level, and over and above that responsibility lies with the management and board of directors. So we will go to them, and we are not reporting to the CFO. So we are reporting to those charged with governance and the shareholders of the entity. And accordingly, we will communicate with those charged with governance and agreed upon this. That will be the better way of handling this. As far as the fee is concerned, you have to assess, is it a correct fee to carry out the engagement? If it is, because that is a valid reason for withdrawing from the engagement. So you can decide on that. It is case to case basis. The auditor has to make his own judgment. Okay, sir. Next one, sir.
Next one is, sir, a
A
client
client
repeated.
refuses to allow you to verify inventory at a key warehouse, citing security concerns. However, they still want you to issue a clean audit report for the entire financials. How should you respond to this scope limitation under SA 210 before accepting or continuing the engagement? See, SA 601, along with SA 210, when you assess, the inventory observation process is a responsibility of the auditor to ensure that because inventory is normally a key component of the financial statement. You wanted to ensure that nothing goes wrong. Material misstatement is not arising. In fact, it also goes to the extent of talking about in SA 240, auditor should bring in a concept of unpredictability of which warehouse I wanted to choose. So if they are saying that this has to be totally avoided, you tell them that if the material amount of inventory get proper evidence of existence of that inventory, we have to think about doing an alternative procedure. Say, for example, entire inventory has been subsequently sold and money has been collected. That is an alternative procedure of confirming the existence. You can do that. But in CARO reporting, you are specifically required to say whether the management has carried out the physical verification and whether they have identified any deviation of 10% and above for each class of inventory. Those aspects, how you are going to address also, you please look into that. My suggestion is this is a important scope limitation. You have to assess based on the risk and then take a call on this. Yes, sir. Is the letter of engagement mandatory even while accepting audit engagements of small companies or SMEs? Given their size and the informality, can we rely on oral understanding, or does 210 require a formal written agreement in all cases, regardless of the client size? Letter of engagement is a foundation, sir. Accordingly, it is required to be there for every engagement, not only audit engagement, for other engagement also, it is advisable to have this. And accordingly, you have to have it even for SMEs. Yeah. Anything else, sir?
Yes, sir. One more question. Sir,
How should an incoming auditor proceed if the previous auditor is neither providing no objection certificate nor responding to emails, calls, or formal letters? What guidance is available in such situations? And can the audit be accepted without an NOC? Sir, if you see the code of conduct and communication with the previous auditor, it only requires you to wait for a reasonable time for his response. If he is not responding to any of your request emails and other things, document all those things, wait for a reasonable time, and then you can proceed to carry out the audit. But the problem majority of the times is that we don't have the evidence of sending him proper communication. So you please ensure that your communication has been properly sent and you have evidence of having sent that. In that case, wait for a reasonable time. If he is not responding, you can proceed with carrying out the assignment. The guidance is available in the Institute Standards on Auditing itself. Please, sir.
okay. Okay, sir. That was the last question, sir. This
Yeah.
was the last question. Okay. So now all questions we have taken, sir.
Okay. Thank you so much, Vivek.
Thank you, sir, for taking your time, sir, for
Thank
this
you.
session. Thank you, sir.
Thank you all the participants for being with me for the past 3 hours. Thank you very much. Thank you.
Thank you, sir. Yes, yes.